So we've got the stack of sources today, all focused on the really intense fight over U.S. healthcare policy, and it's happening right now, set against this backdrop of the longest government shutdown in U.S. history.
Yeah, it's a huge mess. And healthcare subsidies, that's the absolute core sticking point in this November 2025 shutdown.
It really feels like it comes down to two totally different paths, right?
Absolutely. On one side, you've got the Republican push figures like Trump, Scott, Graham basically saying terminate Obamacare. They want to take, hundreds of billions from insurance companies and give it directly to people through these expanded HSA-style accounts, health savings accounts.
Okay, and then the Democrats, Schumer, Sanders, they're pushing the other way.
Completely. They want to make the expanded ACA premium tax credits permanent. Lock in that coverage stability that millions rely on under the Affordable Care Act.
So our mission today is really to unpack this whole conflict
Right.
because as the sources show, it seems to boil down to this one big question.
Exactly. Are we okay with a system where the government help, the subsidy, is fundamentally regressive, meaning it helps wealthier folks more through tax breaks, like with HSAs?
Or do we prefer a progressive system, one that focuses on stabilizing coverage for lower income, more vulnerable people through direct help paying premiums like the ACA does?
That's the choice. That's the policy clash we're digging into.
All right, let's start with the first approach then, the Republican idea. This promise of consumer-driven healthcare, mainly through expanding HSAs.
Okay, so HSAs. Basically, an HSA is a special savings account. It's tax advantaged, and the idea is it puts you, the patient, more in control of your healthcare spending.
And it's usually paired with a specific type of insurance plan, right?
Typically, yes.
Yeah.
A low premium, high deductible health plan. The thinking is if you're spending money from your HSA account for most things below that high deductible, you'll shop around more carefully. You'll be more price sensitive.
And people seem to like them. The numbers we have here are pretty striking.
Oh, incredibly popular, judging by the stats from advocacy groups. Over 35.5 million HSAs active right now.
Wow.
Yeah, and that covers nearly 72 million people. So it's not just a niche thing. And it shows its appeal goes beyond just healthcare spending. It's seen as an investment tool, too.
Right, because of the tax benefits.
Absolutely. It's got this triple tax benefit, which is honestly pretty powerful for savings.
Triple tax benefit. So walk us through that.
Sure. Money you put in,
Yeah.
tax-free. Any interest or investment gains inside the account, also tax-free. And then when you take money out for qualified medical expenses, still tax-free.
So tax-free going in, growing, and coming out.
Exactly. Input to output, completely tax-free for healthcare, which, makes it one of the best investment vehicles out there, especially if you can actually afford to put the maximum amount in each year.
And the argument from proponents is that this actually lowers healthcare costs overall.
That's the claim. There's research cited by a coalition pushing for expansion. It suggests HSA users spent like 5 to 7% less on total healthcare costs compared to people in traditional plans.
And that includes prescriptions, too.
Yep, 6 to 9% less on pharmacy spending. And crucially, they say this happened without people skipping necessary primary care or preventative stuff.
That does sound compelling, but I guess the question is why they spent less.
Right, that's the critical question a skeptic would ask. Are they genuinely making smarter choices, finding better deals? Or is it simply that the high deductible makes them think twice, maybe even forego care, this, borderline or non-essential? Either way, if you can contribute consistently, the long-term savings potential is massive. We're talking potentially hundreds of thousands of dollars over a career, like $360,000, maybe even $600,000 over 40 years, depending on investment returns.
So with that potential, it's no surprise there's this big legislative push. You mentioned the Personalized Care Act. What's the main goal there?
The core idea across many of these proposals is to decouple HSAs from needing that high-deductible health plan.
Ah, okay, so anyone could have one.
That's the goal. Expand the number of accounts. Let any American, even if they're uninsured, open an HSA. Basically, turn it into a universal savings account just for medical stuff.
And make it easier to use the money, too.
Exactly. Things like the Bipartisan HSA Improvement Act want to let you use HSA funds tax-free for stuff like monthly doctor fees, or even move money easily from other accounts like FSAs. It's all about consumer choice and, frankly, deregulation.
Okay, but that deregulation, that expansion, it brings us right to the big criticism, the equity problem. If the goal is universal access, critics say the current HSA structure is actually working against that, this whole upside-down subsidy idea.
Yeah, this is a really important point. The argument is that the way we subsidize HSAs right now is, well, fundamentally backwards. upside down.
How so?
Because the government's help comes as a tax deduction, and the value of that deduction depends entirely on your marginal tax rate.
So the more you earn, the higher your tax
And
bracket.
the bigger your tax break. Exactly. Let's put some rough numbers on it. Someone in the top tax bracket, putting the maximum into an HSA, might save, say, close to $3,000 in taxes. That's their subsidy.
Okay.
But someone earning much less in a lower tax bracket, they make the same contribution, but their tax saving, their subsidy, might be less than $700.
Right. So the person who likely needs the financial help the least gets the biggest benefit from the government.
Precisely. It's regressive. And this whole dynamic gets even stronger when you consider HSAs as retirement accounts.
Because you can take the money out later for anything.
Right. Once you hit 65, you can withdraw HSA funds penalty-free for any reason, not just healthcare. It basically becomes this supercharged tax-advantaged retirement fund. And unlike a 401k or IRA, there are no required minimum distributions.
Wow. So it's a fantastic tax shelter, especially if you're a high-income earner who doesn't need to tap into it for current medical bills.
It really is an excellent privileged tax shelter.
So if the current system has this built-in bias towards the wealthy, but you still want the potential benefits of consumer choice, how do you fix that? I see we have this alternative idea here, the equitable HSA.
Yeah, this is an interesting proposal from policy experts trying to bridge that gap between the left and right.
How would it work?
Instead of that regressive tax deduction, it proposes targeted help. For lower-income folks, say up to 400% of the federal poverty line, you'd get direct cash grants deposited into your HSA, maybe $300 to $1,000 per person.
Okay, actual cash up front. And for higher earners.
They'd get tax credits instead.
Yeah.
The logic is pretty straightforward.
Give people who don't have many resources the actual money so they can participate in the market as price-sensitive consumers.
Exactly. And the data shows this help is badly needed. I mean, you see numbers like 44% of adults can't cover a surprise $400 medical bill, and about a quarter are putting off care because they can't afford it.
That's sobering.
It is. So the Equitable HSA tries to address that head-on. But it also suggests tightening the rules a bit to make sure the money is really used for healthcare, not just becoming another general tax shelter. So maybe penalties for non-medical withdrawals even after you turn 65, things like that.
And what's the estimated cost for something like this?
For a basic model, just the cash grants for lower-income insured people, the estimate is around $50 billion a year.
Okay, $50 billion. That's a significant number, but it gives us a really useful comparison point when we look at the other side of this debate, the ACA subsidies. What's the cost of that progressive alternative, and what are we getting for it?
Right, because the ACA's expanded premium tax credits, the PTCs, that's what's really at the heart of this current shutdown fight.
Okay, hang on, just to clarify for everyone listening. The premium tax credit, the PTC, what exactly is that? Is it cash, a deduction?
Good question. Think of it as the main engine making the ACA marketplace work for affordability. It's a direct subsidy from the government that lowers your monthly health insurance premium.
And it's based on your income.
Directly linked to your income. So the lower your income, generally the larger the credit, making the insurance premium affordable. It's designed specifically for low and middle income Americans.
Got it. And the cost to make the expanded version of these credits permanent? That's where the big numbers come in, right, from the CBO?
Huge numbers. The Congressional Budget Office looked at this just recently, making those expanded PTCs permanent. They estimate it would increase the federal deficit by $350 billion over the next 10 years, 2026 to 2035.
Wow, $350 billion. That's a massive investment.
It is. But according to the CBO, that money has quite a lot in terms of stability and coverage.
Like what?
They project it would mean nearly 4 million more people having health insurance by 2035. And because those newly insured people would likely be healthier on average, it would actually lower the benchmark premiums for everyone in the marketplace by about 7.6%, a healthier risk pool.
Okay, so high cost, but significant coverage gains and potentially lower premiums overall. That really contrasts sharply with what some older modeling showed about repealing the ACA, doesn't it?
Oh, absolutely. If you look back at models, like from the Commonwealth Fund, examining what happens if you just repeal the ACA and maybe replace it with some of these market-based ideas, tax deductions, block grants.
The impact is pretty devastating.
Yeah, the coverage loss is dramatic. Full repeal alone was modeled to leave almost 20 million more people uninsured. And if you added in some common replacement ideas, the number of uninsured could jump by 16 million to even 25 million people compared to the ACA baseline.
And it hits vulnerable people the hardest.
Disproportionately. Millions of people who reported being in fair or poor health would lose their coverage under those scenarios. And even for those who managed to stay insured, say, in the individual market,
Their costs would go up.
big time, an immediate out-of-pocket shock. Average annual spending for folks in the individual market was projected to jump from around $3,200 under the ACA to $4,700 with a full repeal.
And what about that idea of selling insurance across state lines? That's often pitched as a way to increase choice and lower costs.
Well, the modeling suggested that could actually lead to the highest average out-of-pocket costs, maybe close to $5,700 a year,
Why so high?
because it tends to lead to a race to the bottom. Insurers offer really cheap, bare-bones plans with very limited coverage and high deductibles to attract healthy people, leaving sicker people with fewer, affordable, comprehensive options.
So it really crystallizes the trade-offs. We have these two very expensive but fundamentally different ways the government can spend money on healthcare.
Exactly. One path, the ACA subsidies, provides broad stability and coverage, especially for the less well-off, using progressive subsidies, but at a very high federal deficit cost.
And the other path, expanding HSAs, offers personal savings incentives and potential market efficiencies through essentially regressive tax breaks, but risks leaving more people uninsured or underinsured.
That's the core tension.
Now, if HSAs are really going to empower consumers to shop wisely, they need one key thing: price information. Which brings us to transparency. This seems to be something both sides, or at least market-oriented reformers, often talk about.
Definitely. You see price transparency as a big part of plans like the America First Healthcare Plan. The goal is clear: lower costs by letting people compare prices, shop around, and also put an end to those awful surprise medical bills.
The basic economic idea: if everyone knows the prices, competition will drive them down.
That's the assumption. And it was behind things like the 2019 executive order trying to force hospitals to publish the prices people actually pay, not just the sticker price.
Does it actually work that way in healthcare, especially given how consolidated the market is?
Well, that's where the counter research comes in, and it's pretty thought-provoking. It suggests maybe transparency doesn't always lead to lower prices.
Really? What does it show?
Studies looking at other markets, not healthcare, but markets like, say, ready-mix concrete in Denmark, found something surprising. When companies were forced to reveal their negotiated prices.
Prices went up.
They did, by like 15 to 20% in that Danish concrete example.
Wow. So instead of fostering competition, it basically allowed the few big players to see what everyone else was charging and collectively raise their prices towards that revealed level.
Kind of like setting a price floor instead of driving prices down. If there are only a few dominant players and high barriers for new companies to enter, which sounds a lot like many U.S. healthcare markets, transparency might backfire.
That's a really powerful counter-argument and explains why industry groups push back.
It does. Hospital groups, insurance groups, they've fought hard against being forced to disclose their secretly negotiated contract rates. They argue it won't really help consumers navigate their own out-of-pocket costs and quality, which is what they say matters most.
Okay, so let's try and synthesize this whole policy clash then. We have this push towards market efficiency, expanding HSAs, pushing for transparency. But it comes with, as we've seen, a significant risk of higher costs and less coverage, especially for lower income folks and those with health problems.
Right. And on the other side, you have the push for progressive coverage, mainly by making the ACA's premium tax credits permanent. That ensures broader stability, more equity in coverage, but carries that massive federal price tag, the $350 billion over a decade we talked about.
So the key takeaway for you listening seems to be that this whole debate isn't just about choosing which healthcare system we want. It's fundamentally about how we decide to distribute government money.
Is it through regressive tax deductions like the current HSA system?
Mm-hmm.
Or through progressive targeted subsidies like the ACA? Both cost a lot, just in different ways and with different impacts on different groups.
Which brings us back to that equitable HSA idea we discussed earlier.
Yeah, that proposal tried to blend progressive ideals, those cash grants for lower incomes, with market mechanisms like HSAs. It makes you wonder.
What's that?
Well, looking forward, if we want to get past this political deadlock and find a sustainable path for healthcare policy, maybe the only way is to explicitly link market-based ideas with guaranteed progressive funding to ensure equity, instead of treating them as totally separate, opposing choices.
That's definitely something to think about, especially as this government shutdown drags on. We'll be watching closely. Thanks for breaking that all down.
My pleasure. Join us next time for The Deep Dive.